Most people have a pretty simple idea of how banks work. You deposit your money. The bank holds it safely. And when you need it, you withdraw it. Maybe you assume the bank makes money by charging interest on loans, and that's about it. But the reality is a little more complicated than that. Banks aren't just vaults that store money. They're financial businesses, and extremely sophisticated ones at that. Every time you deposit money, swipe your card, take out a loan, or even accidentally overdraw your account, there's a system running in the background designed to generate profit. And once you understand how that system works, a lot of everyday financial decisions start to make much more sense. So in this video, we're going to break down the 4 main ways banks actually make money in clear, practical terms, and more importantly, what that means for you as a customer. Because the truth is, banks don't just make money from banking. They make money from patterns in human behavior. And once you see those patterns, you start to notice them everywhere. Now let's talk about what a bank really is. Before we talk about how banks make money, it helps to understand what a bank actually is. Most people think of a bank as a place where money is stored. But from a business perspective, a bank functions very differently. A bank is essentially a financial intermediary. In plain terms, that means it sits in the middle of 2 groups. People who have money to deposit and people who want to borrow money. When you deposit money into a checking or savings account, the bank doesn't simply lock it away and wait for you to come back for it. Instead, that money becomes part of a much larger pool of deposits that the bank manages. Your individual balance is still tracked, of course, but the bank uses the total pool of deposits to support lending, investments, and other financial activity. That's why banks are able to offer loans for things like mortgages, auto loans, business loans, credit cards, and personal loans, even though the cash technically came from depositors. In other words, banks are constantly moving money through the financial system. Deposits come in, loans go out, payments flow back, and somewhere in the middle of all that activity is where the bank earns its profit. So first, let's talk about the core engine of bank profit, interest. The single biggest way banks make money is through something called the net interest margin. It sounds technical, but the concept itself is pretty straightforward. Banks pay depositors a small amount of interest for keeping money in savings accounts. Then they lend most of that money out to borrowers at a higher interest rate. The difference between those 2 numbers is where the bank earns a large portion of its income. For example, imagine this simplified scenario. A bank pays you 0.5% interest on your savings account. At the same time, that bank issues loans, like mortgages or personal loans, at 6% or 7% interest. That spread between the 2 rates is called the interest margin. So if the bank is paying depositors 0.5% but earning 7% from borrowers, that gap helps cover operating costs, risk, and ultimately generates profit. Now there's an important detail here that often surprises people. Banks are not lending out from your exact account one for one. Instead, all deposits are combined into a large shared pool. Your account balance is still recorded precisely, but the bank uses the total pool of deposits to fund loans while keeping enough reserves available for withdrawals. This is why banks can issue many loans at once without needing to match each loan to a specific person's deposit. The system works because, in practice, not everyone withdraws their money at the same time. So the bank manages the overall flow of deposits and withdrawals while putting the majority of funds to work. And when those loans are paid back with interest, that's where the bank begins earning money. But interest income is only one part of the story. Because beyond lending, banks have several other ways of generating revenue, some of which people don't notice until they look closely. And the next one is something almost every bank customer encounters at some point. It's fees. Let's talk about it. Interest may be the engine of banking profit, but fees are the smaller pieces that quietly add up over time. Most people have encountered at least one of them. Things like monthly account maintenance fees, ATM withdrawal fees, overdraft fees, late payment penalties, service charges for certain transactions. Individually, these charges might seem small, but across millions of customers, they become a significant source of revenue for banks. Overdraft fees are a good example. If your account balance drops below 0 and a transaction still goes through, the bank may charge a fee, often around $30 or $35. That means a small purchase could suddenly become much more expensive. Over the years, overdraft and insufficient funds fees have generated tens of billions of dollars in revenue for U.S. banks. Now, to be fair, the industry has been changing. Some banks have reduced or eliminated certain fees in order to attract customers, especially as online banks and fintech companies have increased competition. But the underlying idea hasn't changed. Fees exist because they're profitable. They're a way for banks to generate additional income beyond interest, often from everyday account activity. And because they're tied to behavior, they can be surprisingly consistent revenue sources. Now let's talk about card payments and interchange fees. Another way banks earn money happens almost every time you use your debit or credit card. When you swipe or tap your card at a store, there's an entire payment network working behind the scenes. The merchant receives the payment, but in order to process that transaction, the merchant also pays a small fee. Part of that fee goes to the card network companies like Visa or MasterCard, and another portion goes to the bank that issued your card. That portion is called the interchange fee. For a single purchase, it might only be a small percentage. But when you multiply that across millions of daily transactions, it becomes a meaningful stream of income. This is one of the reasons credit cards often offer rewards programs. Cashback bonuses, travel points, and other perks are partially funded by those transaction fees. So even when you're not paying interest, your bank may still earn money every time you use your card. Investments and financial assets. Banks also generate revenue by investing some of the funds they manage. Again, the money isn't just sitting idle in a vault somewhere. Banks hold portions of their assets in things like government bonds, treasury securities, corporate debt, and other financial instruments. These investments help banks earn returns while maintaining relatively stable and liquid portfolios. At the same time, banks must follow strict regulations about how much money they keep available for withdrawals and how much risk they take with investments. But the basic idea is the same. The bank is constantly managing money in ways that produce income through lending, payments, and financial assets. Now let's put it all together. When you step back and look at the big picture, the banking model becomes much clearer. Banks generate profit through several interconnected mechanisms. They earn interest by lending money at higher rates than they pay depositors. They charge fees for certain services and account activities. They receive interchange payments when customers use debit or credit cards. And they invest portions of their assets in financial markets. Together, those four pieces form the foundation of modern banking revenue. Here's why this matters for you. At this point, you might be wondering why any of this actually matters. After all, banks are businesses. Of course, they're trying to make money. And that's true. But understanding the system changes how you interact with it. Because most of the money banks earn from customers doesn't come from people intentionally paying them. It comes from small financial habits repeated over time. Things like paying avoidable fees, keeping money in accounts with very low interest, using services without comparing alternatives. None of those things feel dramatic in the moment, but over years, they can quietly cost hundreds, sometimes thousands of dollars. Once you understand how banks earn money, it becomes easier to make small adjustments that work in your favor instead. For example, avoiding unnecessary fees, choosing accounts that don't charge monthly maintenance costs, using ATMs within your bank's network, and keeping savings in accounts that offer competitive interest rates. Today, many high-yield savings accounts offer around 3 to 5% annual interest, which can be dramatically higher than the rates offered by traditional accounts, with the same FDIC protection and same basic function, just a much better return. Small decisions like that can make a meaningful difference over time. Now here is the big takeaway. At the end of the day, banks are not mysterious institutions. They're businesses built around a simple idea. Move money through the financial system and earn a margin along the way. That doesn't make them good or bad. It just means the system is designed to generate profit. And once you understand how that system works, you can interact with it much more intentionally. Instead of unknowingly paying extra through fees or low-interest accounts, so you can make choices that keep more of your own money working for you. And that's really the goal. Not avoiding banks altogether, but understanding them well enough to use them wisely. If you actually want to understand how money works beyond what I covered here, I left something in the description that breaks it down really simply. Thanks for watching. If you found this helpful, like, comment, subscribe, and let me know what financial topic you'd like broken down next. I'll see you in the next video.